Everyone freaks out when prices go up a little. Nobody talks about what happens when they go up a lot. That's the one you should actually be worried about. You check your grocery receipt and squint at the total. Feels high, but you can't quite remember what it used to cost. That's the first trick inflation plays on you. It moves slow enough that you don't notice until it's already done the damage. So, here's what actually happens to your money and your life when inflation doubles. First, let's make this real. Inflation doesn't feel like a crisis at first. It feels like an annoyance. Your coffee is 50 cents more. Gas is a little painful. You adjust, you grumble, you move on. But inflation doubling isn't a 50-cent problem. It's a structural problem. It quietly reaches into every corner of your financial life and takes a cut. And most people don't feel the full weight of it until it's already too late to respond. Your purchasing power. This is where it starts. Purchasing power is just a fancy way of saying what your dollar can actually buy. When inflation doubles, your dollar buys less. Not a little less. Measurably, significantly less. Here's the math that nobody puts on the news. At 2% inflation, the Fed's target, the number everyone calls normal, prices double roughly every 35 years. At 4% inflation, prices double in about 18 years. At 8% inflation, prices double in 9 years. 9 years. And here's what that looks like in real life. A grocery cart that cost $150 in 2020 cost over $190 by 2024. Same items, same store, same cart. $40 more. Just for showing up 4 years later. That's not a rounding error. That's a different life playing out one receipt at a time. Your savings account. Here's where it gets brutal. Most people think saving money is safe. It's not. A savings account earning 0.5% interest while inflation runs at 6% isn't protecting your money. It's losing 5.5% of its purchasing power every year, quietly, without any dramatic notification. No alert, no warning label, just slow, invisible erosion. Here's what it actually costs. $10,000 in a 0.5% savings account during 6% inflation loses roughly $550 in real purchasing power every year, without a single dollar leaving the account. The number on the screen stays the same. What it can buy does not. It's like a leak in a boat you can't see. Everything looks fine until you notice how low you're riding in the water. That's the cost of playing it safe. Your paycheck. Now it gets personal. When inflation doubles, your salary doesn't automatically follow. Most employers give raises once a year, maybe 2 to 3%. If inflation is running at 6 or 8%, your raise isn't a raise, it's a pay cut. Here's a real example. You earned $60,000 in 2021 and received a 3% raise each year through 2024. You gained about $5,400 on paper. But inflation ran hot enough over that same period that your real purchasing power actually declined. You made more. You had less. Most people never connected those two facts because the number on the paycheck kept going up. The number went up. The life went down. That's the cruelest part. Your debt. Okay, here's the twist. Not everything about inflation is bad. If you have fixed rate debt, a mortgage, a student loan locked at a low rate, a car payment that doesn't change, inflation actually helps you because you're paying back tomorrow's dollars using yesterday's rates. The bank lent you money worth more than the money you're paying back. You win that trade. Their fixed monthly cost became relatively cheaper over time. That's not luck. That's how the math works. Inflation punishes savers and rewards debtors. Specifically, debtors with fixed rate, low interest debt. Not credit card debt. Never credit card debt. That's a different nightmare entirely. Your investments. This is where it splits into two very different stories. Story 1. You're holding cash, bonds, and low-yield savings products. Inflation is your enemy. The returns don't keep up. The real value of your portfolio quietly declines. You feel fine because the number isn't shrinking, but in terms of what you can actually buy with it, you're falling behind. Story 2. You're holding equities, stocks, specifically companies that can raise their prices as costs go up. Consumer staples, energy, real estate, commodities. Historically, equities have been one of the most reliable long-term hedges against inflation. The S&P 500 has averaged roughly 10% annually over the long run. Inflation has averaged around 3. The gap between those two numbers is your real return. And here's what that gap looks like over a real inflationary decade. During the 1970s, one of the worst inflation periods in modern U.S. history, the stock market still outperformed cash and bonds over the full decade. Investors who stayed in came out ahead. Investors who moved to cash to wait it out lost ground they never fully recovered. Protect the gap. Your mindset. This is the part nobody talks about. When inflation doubles, something weird happens to how people make decisions. They start spending faster, not because they're reckless, because they're rational. If everything is going to cost more next month, buying now makes sense, which means more demand, which means prices rise faster, which means everyone buys even faster. Economists call this an inflationary spiral. Your grandparents call it the 70s. Here's how bad it got. Between 1972 and 1982, the US dollar lost roughly half its purchasing power. A dollar in 1972 bought what 50 cents bought 10 years later. In 1 decade, it self-reinforces, and the psychological damage lingers long after the inflation itself fades. People who lived through it describe a permanent shift in how they relate to money. They distrust savings. They distrust paper currency. They hoard physical assets. That's not irrational given what they experienced. It's a reminder that inflation is not just a financial event, it's a psychological one. What you can actually do. Here's where most finance content goes soft and vague. Not here. Number 1. Stop holding excess cash in accounts that earn less than inflation. High-yield savings accounts have paid between 4 to 5% in recent years, well above the traditional savings rate of 0.5%. That difference is not small. On $10,000, it's the difference between earning $50 a year and earning $450. Use them. Number 2. Equities over everything for the long run. Not individual stocks, not options, broad index funds held for decades. That's the inflation hedge hiding in plain sight. Number 3. Real assets. Real estate, commodities, and inflation-protected securities like TIPS exist specifically to move with prices rather than against them. They're not exciting, they're functional. That's the point. Number 4. Fixed-rate debt. If you can lock in a low fixed rate on something you were going to buy anyway, do it. Let inflation do the work for you on the back end. Number 5. Your income. The most underrated inflation hedge is the ability to earn more. Skills, negotiation, career moves. Inflation that hurts your expenses is devastating if your income is fixed. It's manageable if your income can keep pace. Invest in the thing that earns. The part nobody wants to hear. Most people don't change anything when inflation doubles. They complain. They adjust spending a little. They wait for it to go back down. And sometimes it does. But sometimes it stays elevated for years. The people who waited to respond lose ground they never recover. The gap between someone who repositioned early and someone who waited shows up in retirement accounts, in home equity, in the difference between having options and not having options 20 years from now. Inflation doubling doesn't feel like an emergency. That's what makes it dangerous. It doesn't arrive with sirens. It shows up in a grocery receipt, a utility bill, a rent renewal letter. slow enough that you keep adjusting instead of acting. But the people who treat it like the financial event it is, who move money into positions that can grow with it or ahead of it, come out the other side with more than they started with. The people who leave everything in cash and wait for things to feel normal again, they come out behind. Sometimes a long way behind. You already know what inflation is. Now you know what it actually does. The only question is whether you do something with that. Starting today. Because the worst response to inflation isn't panic, it's nothing. And nothing is exactly what most people do. Don't be most people.